everybody, this is Joe with FX Daily Breakout. My wife sent out the email to everyone about our daily strategy we use to enter and exit the market. Right now we're looking at Euro USD. I start off with the recent price, work my way from recent price down or up. I'm always working my way from previous price to see where it came from to identify the trend. Take my drawing tool and I mark these levels in just to be positive of which direction the market is going. It just helped me out a lot. So we have our highs and lows, identifying highs and lows. It's a good habit to do, drawing these in. It's something that keeps your eye aware of where price came from the past and where you can see turnarounds in the future. Another good habit to do is actually drawing the trend in. I use wicks with my trend, or when I'm drawing, when I'm using price levels, or when I'm drawing trends in. So I go from the most recent bottom wick up to the top wick. I'll bring this in a little bit more so you guys can see what's going on. Highs, low, high, low. Just highs to lows. Just keeping it basic and simple. Come on. And as simple as this may seem, this makes the trading that much more easier. Now that I have identified the highs and lows, identified that I'm in an uptrend on the daily chart, I like to try to find support resistance levels. And the most recent support and resistance levels. So right now, this is where we are at price. I'm gonna clear this chart up a little bit so we can actually see the support and resistance levels a little bit more clear. And just having a visual of drawing your trends in and drawing the highs and lows, you will notice a lot that how price, when it broke through the last recent price level, that how it comes back and retests that price level. Alright, so here's support and resistance. As far as support and resistance, I like to see it be the price line being touched at least twice, twice or more. And when I'm drawing these levels in, I don't look at them as just a line. I look at them as if they were zones. And here is a zone here. Well, here's the price line, the price level here that was hit 2 to 3 times. Here's a price level here. That's 2 to 3 times. Price level here. 2 to 3 times. And here. We'll even draw that one in also. We go back and past, let's see, where was this price hit? So as you see, even back in history, you can see that level was a actual good level to trade off of. All right, now that we know about our support and resistance, coming from where price is at the moment, all we can do is go back deeper in history, because as you see, all this time here, that price never reached that level until back here. That's 5-2 of last year, 2016. Price hasn't been here basically in almost a whole year. I'm gonna squinch the chart up to see if that price line been hit, more than that time. As you see here, 1, 2, 3, and even 4. I'm gonna draw this price level in, reaching to current price. So now we're here at current price. What I do after I acknowledge that I'm at a price level that's significant to make a trade, go down to the 4-hour time frame. And in my 4-hour time frame, I look for engulfing candlesticks. These engulfing candlesticks at current price was at current price, or at that price level, put in an engulfing candlestick here with this bullish bearish candlestick. Now, when I see these happen, I get involved in this trade aggressively, meaning that once this candlestick closes, I enter the market here. Once that I enter the market, I try to go to the top of the highest high of that wick, and I tend to put my stop loss 10 pips above this wick. So this price level is 1583. We will take it up to 1593, and I'm just going to draw in a level, that way we can identify it. And from where I entered the trade is 1553. Well, the threes is good, right? And that'll be 40 pips. So from our stop loss, we at least got to get a 1-to-1, and we would take that down to 1513. And here at 1513, targets was hit. And after you notice targets is hit, you will see as a lot of the bears that was in the market let their positions go. I mean, they closed their position at this area because as you see the bulls get in and attempt to put in an engulfing candlestick here and to drive the market back up. Now, with this being a daily level, you can go for multiple targets. And what I mean by going to multiple targets, once this target is hit, you can take off part of your position, move your stop to break even. Here, now you're in a free trade. You took some money off, you put money in the bank, and you're basically in a free trade to let this trade run. And that's what you want to try to do to get the most out of your trades. Take money off for the first take profit area, and usually these areas are always at previous structure levels. As you see how price came up into here, and it sold off and then pushed out of there. This is basically where a level where price was, people acknowledge these price zones. So when you see these areas, you want to identify them and make sure you pay close attention to them. And that's just a brief explanation of how I entered the market on the 4-hour time frame. I do use Fibonacci's, I do use structure levels, a host of other things, but this is just a basic things. If you guys need any help or want to know more about it, just send an email or get with us on Facebook, and we'll try to link up and get some things handled. But as far as the double tops on the 1-hour chart and double bottoms, let me see if we can find something here. And we're going to go to recent price just to see if it was a double top. Nothing as a double top was put in here. So as far as entering on a double top, we wouldn't have had a trade there on a 1-hour time frame. Again, double tops are a conservative way of entering the market. So we're going to go back and see to find us a double top at a structure level. or a double bottom at a structure level. I'll try to get both of them. All right, we might have something here. All right, exactly this price level here. This good area here for a double top. Now I'm gonna draw this in for you. You have price come up into the area, reaching structure levels in the back here. So you know this area, it has some significant reason for the bears to push the market down. Market goes up, comes down, pushes back up into that area, pushes back down. That is a double top. Now what solidifies that double top is a break of the neckline. And this would be considered the neckline here. So once this double top is completed by the break of the neckline with a price closed below it, you can either enter aggressively on this candlestick here, or you can wait for a better price to when it pulls back. And a lot of times I use Fibonacci in this area to capture those the best price to get in the market. And as you see, you know, if you were to enter it conservative and waited on a pullback, that would have been your enterprise, your stop loss 10 pips above 1280, 1283, 1293. Would have been a stop loss up in this area here. And take profits, let me see, 72 to 93, that would have been about 20 pips. So we're looking at 52 for our take profit. And double tops are very, very powerful, because as you see, within the next hour, your target would have been hit. The first targets would have been hit, and within the next hour. So like I said, this was just a brief description on how we enter the market. If you guys need any more information, you're more than welcome to email, get in contact with us. We can go over a few things, try to help you guys out to be better traders, make money, because that's the basic reason why we all in this market, is to make money and enjoy our time. And that about wraps it up. You guys have a great day. I hope you learned some things from here. Take it with you. Make some money. Have a good one, man.